Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is American Express Company, ticker AXP. Over the next 5 minutes, I will discuss both the valuation of this company and my thoughts on whether it's a quality business. So first up this is a consumer finance industrial company. They have subsidiaries that provide charge and credit payment card products, and they operate through 3 segments: Global Consumer Services Group, Global Commercial Services, and Global Merchant and Network Services. So they are best known for the American Express cards. They operate in an oligopoly worldwide, focusing on basically you have American Express, Visa, MasterCard, and Discover. One thing that I know about this industry, because I've looked at it before, is that Visa and MasterCard are only charging basically your swipe fees. They don't take on any loan risk, but American Express take on loan risk. Now that means that those two companies are different than Visa and MasterCard. Visa and MasterCard, of course, pretty high quality businesses. Discover and American Express are different. And so because they're taking on that financing risk, the way that their balance sheet works is also very different. So let's dive into it a little further. Now that the beta or the share turnover are significant here, return on equity, the first thing you're going to see is that they don't have a single year with a loss. That's a very good thing. So over the last 20 years, they've been profitable in all 20 years. That's very attractive. In addition, think about this as a bank. American Express is operating like a bank, and so they make loans through their credit cards, and because they keep those credit card loans on their books, those loans are important here. So when you think about return on equity, you have to think about stuff like the financial crisis. And during 2007, 2008, and 2009, they were profitable. And in the low of 2009, they still had a return on equity of 16%. That's very impressive as a low during the financial crisis for a bank. And so when you think about also 2017, they had a low at 14%. And 2020, during the pandemic, they had a low at 13%. Regardless, they never fell below 10% on return on equity over the last 20 years, and they survived the financial crisis in a very strong manner. I like that it appears that their baseline return on equity is above 20%. That's very attractive as an potential investment. One thing, if you've watched some of these previous videos, is normally you have a chart here of return on invested capital. Well, banks are different. And for them, return on equity as much matters because there's a lot of leverage inherent to this business model. You're always going to have a setup here about like return on assets and return on equity. And generally, you're going to have leverage somewhere in the range of return on equity being 8 to 10 or 12 times as high as return on assets. It's pretty normal here. And here you can see they're turning a return on assets of 3.4% into a return on equity of 27%. That's a very good business. This is top 10%, top 5%, top 1 percentile in terms of financial industry metrics here. So this is a very attractive, strong, high-quality business. All these metrics suggest this is a high-quality business. Price to PE of 18 is very nice. It's a very good number for something that's such a high-quality business, and that's still growing. You can see that they're growing their income at 5.9%. They're growing their loans by 3.4%, and their earnings assets by 2%. So the deposits is also a big number here. So you want to grow your loans by 3.4%, deposits 7%. That means that over time, they're funding more and more of their business by deposits, which allows them to have a better structure of their balance sheet. So, again, for me, I'm really looking at return on assets. That sets the baseline of what you want to see in a business. In terms of banks, I want to see a return on asset at a minimum above 1%, but ideally in the 1.5 to 2% range as my low end. And here we have return on asset of 3.4%. I also want to see them growing, and you have that growth here. So everything I see looks good. You're meeting all my metrics for every year in the past decade, and you have a good strong 20 years here. So there's a limit to what you can do with a financial company in terms of analysis. You need to do a longer, deeper analysis before you ever buy a financial company, but everything I see here is interesting. American Express is going to go on my watch list after this. Discover has already been on my watch list. We'll talk about that one in a future episode. I've actually owned Discover in the past, and I really like what I'm seeing here from American Express. One thing that's been attractive about banks recently is that because of the financial crisis, they've been trading lower than a other business of similar quality would. How many businesses do you know that currently have a return on equity of 27% trade at a PE of less than 20? It's very few. And so it's really attractive what we can see here. And you can see they've tripled their earnings per share over the last decade. That's very, although I say that, but there's something weird happening in 2021, so take that what it is. They've at least doubled their dividends per share, and so you're seeing some very attractive numbers here. See if we can look at shares diluted. So they're buying back shares every year. That's very attractive. You want to see that in a high-quality business. Because they have limited growth prospects, they're dumping that money into shares outstanding being reduced, so I really like what I see there. Balance sheet, again, it's not worth doing too much breakdown on this because without really understanding the quality of these assets, it's hard to do it. But what you want to see is that these deposits are growing, and they've doubled their deposits over the last decade. And so they're able to fund more and more of their balance sheet from deposits versus commercial paper and long-term debt. And so long-term debt's going down, deposits are going up, and that's a really nice setup to see in a bank. Let's see, cash flow. Again, some of these numbers are wonky. This is basically a cash business, and so you can't really assess the financial statements that way. But in terms of what you're looking for in these key ratios, you've hit your return on asset number. You have a good amount of leverage. The PE is attractive. Again, I like to buy things under 15, but things are probably going to work out well for you with PE of 18 because not only you're basically getting some of the benefit of being a swipe card business like Visa and MasterCard, but you're also getting some of the benefit of trading at a low multiple because you're a bank. And so American Express is in a really nice setup here, and it will go on my watch list after this review. Don't forget to hit that like button, subscribe to the channel, and hit the bell so you get notifications as I publish up new episodes. Thank you for listening, and until next time, stop paying fees, start building wealth.